Good morning, everyone, and welcome to this FOMC Intraday Strategy webinar. Today is Wednesday, December 16th. Good to be with you guys this morning. It's an exciting day here in New York. Obviously, at 2 p.m. Eastern, we get the final interest rate decision for the year. Expectations are high that we will get a 25 basis point hike in the benchmark interest rate. More importantly, it's all about the projections, and it's going to be all about the projections. At this point, again, let's just look at some basic data before we get started. First of all, Premendra, good morning. Mario, Masanari, Munho, Chris, great to see all of you guys here. Good morning to you as well. So, relative performance against the greenback looks like this. You've seen the dollar holding a pretty nice rally off of yesterday's reversal, or off of yesterday's outside day candle, I should say. Strong against all its major counterparts, save the Swissy and the Aussie, with basically holding their own. The dollar's at a very interesting juncture heading into today. We talked about it yesterday. 12,123 was the near-term bearish invalidation level. We came into that yesterday, tagged it almost perfectly before pulling back. So the actual high was 12,126. Here we are yet again pressing through this region. I'll show you the scalp in a moment. We had it on yesterday's report, but the dollar's at a resistance within a downtrend, within a near-term downtrend heading into the data. So if we do get the hike, but they sound more dovish, you'd look for an initial rally, and then the market will start to fizzle out, come off. 12,146 is the last barrier of resistance for this downtrend. Might be a good entry on a short if we get the knee-jerk reaction up there. A break above this, and you're basically looking for the high day close at 12,193. Before we get deeper into price action, I just want to take a minute and talk about what we're going to get today from the Fed and what we should be looking for. So I put a piece together here for you guys yesterday. The main thing is going to be the dot plot. So here's what we saw last September when we got the dot plot from the Fed. You saw only about 3 participants thinking policy firming was appropriate into 2016, with the majority here in 2015. More importantly, it's this distribution here. If you look at the previous dot plot, so here's the dot plot from June, you can see the distribution difference. Okay, you had most of the majority thinking that we could see rates between 2 to 3%. You had 6 participants up there. Last quarterly projection, you saw that dwindle down to 4 participants, with the bulk seeing a 1 to 2% interest rate heading into 2016, or for the year of 2016. So you're seeing those interest rate expectations start to be brought in. If this dot plot shows a further deterioration, meaning they're bringing those dots down, look for the dollar to come off. Very simple. We've been pricing in this interest rate hike for quite some time now. Again, as I said in the piece, the risk is if they don't now. The market consensus, and we can, you don't have to take my word for it. We can just take a simple look at forward futures. Okay, and here's what that looks like. So remember, we looked at this yesterday. Oh, sorry about that. We looked at this yesterday. It was at about 74%, now floating at 76% of a probable move today, between 25 to 50 basis points. We've been in this range, obviously, for a prolonged period at this point. The highest expectation in the market consensus as far as a move between 25 to 5 basis points, or 50 rather. So the expectations are there. The real threat, or the real volatility maker here, is going to be whether we see those dot plots shift out, whether we see any downward revisions to the growth, inflation, or interest rate forecast. So the devil's in the details with these quarterly projections. Don't go and just jump into the trade on a knee-jerk reaction on whether they hike or not. That's not the issue here. The issue is the scope, and the timing and the pace of tightening moving forward. Does that make sense, guys? It's really important that we kind of get what the market's going to be looking at tonight. Okay. So with that in mind, we know what we're looking for with the release. We know what the timing is. 2 o'clock, we get the release. 2:30, you get the presser. The question and answer period is a lot of times where you get the most of the volatility during that press conference. She's going to read the statement that we're all going to get previous at 2 o'clock, and then she'll jump into the Q&A section, and that's when you start to get a little bit more color on where the committee stands. We'll also be looking for the GDP and unemployment forecast, as well as the PCE inflation, which is the Fed's preferred inflation gauge, and obviously GDP and employment projections will be released at the same time. Any questions on specifically the Fed before we jump into the charts here? Okay, one of those days you want to stay sharp and we want to stay ready. All our setups are sort of pending, so let's just jump through some of the setups we've been looking at. First, here's what the dollar index looked like yesterday on the 30-minute. Major key resistance here beyond that 12,123 was a nice confluence 1618 extension off the low, and basic median line parallel. This is just a parallel of the same slope. We're sitting there right now, or that's at least what we tagged a few minutes ago. Boom. Okay, so we're at that region right now. A break beyond here, and you're looking at that 12,146 level. It's a little bit more of a critical level. It's been a huge pivot in price. It's the 618 retracement of the entire decline, and that would necessitate a break of that parallel. Such a scenario, you'd basically be looking for the upper median line parallel, guys, if not up into 12,175. So you're heading into some pretty serious resistance. We tested the initial one right here today on a strike, on a knee-jerk reaction. Okay, again, if the policy statement comes out with downgrades to growth, downgrades to inflation, or you see that dot plot really push interest rates out further, expect to see a knee-jerk reaction. If we get one into here, it might be a nice area to start looking lower. Again, on the daily chart, looks a little bit cleaner here. All right, so that's kind of the plan for the upside. On the downside targets here, you're pretty clean. Okay, you're going to be looking for 12,096, the former highs from that Friday advance. It's the 100% extension, and that coincides really nicely with the actual median line we've been working with. So you can see the slope has been offering some really nice reversals, and here we are. This is going to be the breakdown zone that would shift our focus back to that reversal day close again at 12,071, and this is what you're going to call your breakdown zone for the greenback. Questions on dollar index? Again, for those of you stateside, even if we can't trade it, it's something to keep an eye on. Okay, the ICE dollar index is going to be really heavily weighted the euro. So specifically, if the euro starts to make a move and you're watching the ICE dollar index, it's going to be more reflective of that than it is broader market sentiment on the greenback. So something to keep in mind here. All right, let's jump into the nitty-gritty. Here's what we'll be looking at heading into today's interest rate decision. Obviously, the majors are on the table. You've seen most of these come in some very critical regions right ahead of this release. Euro dollar testing the 200-day moving average, next day testing the 100-day moving average. Right here, let me get you that live chart real quick. Well, first things first, here's euro on the daily chart. So there's that 100 and 200-day moving averages. The 100, which was the high, came in at 110.56. And you're basically sitting on that former slope resistance, now support. Again, a slope which has offered very nice pivots in price. Okay, this is a proven slope. This is not a proposed slope. We've seen the market work with this, so here we are offering some support there. It just so happens that yesterday's outside day reversal candle, an extremely bearish sentiment formation, meaning we covered the entire previous day's range and broke to the downside. This encompasses the entire weekly opening range. So the week's opening range is consistent of yesterday's trade for the euro. A break to the downside, you look to play targets into 108.18, 107.87 on a longer term play. Bearish invalidation is going to be a break of the highs. Okay, be looking for 111.20, 112.60. On the near-term chart, let me show you, it's a lot clearer here. It comes with a caveat in that on the advance, we just came shy of that 618 extension. So again, I wouldn't put it out of the realm of possibility for this thing to make another run at the highs, fake out all those guys who are holding weak shorts, and then slam lower. A lot of different ways this could play out, but the bottom line is this: the levels are very clear. 108.95 into 108.90. Nice confluence with 618 retracement, a longer dated 38.2. You've seen a clear pivot in price here, and heading into the afternoon trade session, it's going to necessitate a break back below that median line. So again, our breakdown, quote unquote, zone for the euro, it's going to be somewhere around 108.90, 108.95. And then the targets there are pretty clear to the downside as well. Critical resistance, like we looked on the daily chart, is still going to be up into the 111.20 region if we break above this region. So just keep that in mind. But the targets are all unchanged from yesterday. Avery, I'm sure you have a question here that everyone, I'm sure, is asking, so I'm going to take that right off the bat. Avery, great to see you first of all in the room. Good morning. Says, hi, Mike, big day. How would you trade today? Would you take a position now in FOMC or not at all, even if the setup is viable? Also, post FOMC announcement, when will you be comfortable jumping into a trade? As soon as the level breaks, according to your trade plan, or wait till after the presser to do that? Thanks. Avery, I wish I could outline it for you, step 1, step 2, step 3. I really can't. Okay, on releases like this, you really have to see what the market's reaction is. For example, this is just an example, Avery. Let's say they raise interest rates, dollar sees a pop. You look at the projections, and on the dot plot, for example, you see all of these 2016 projections go sub 2%. That's bearish the dollar. I'd be very, very comfortable jumping into a breakout position, tight stop, letting that play out right off the bat, okay? Because you're seeing a huge divergence in what market consensus is and what the Fed has been saying and what the Fed's saying now. Two things are happening if we start to see these dot plots recede here, specifically in the 2016 and 2017 calendar years now. It means that there's concerns about whether it's domestic issues or global economic problems. Obviously, you've seen the rout in commodity prices be something that's gaining more attention now. Basically, they see threat from financial markets, which is something that, although they continue to say they're not really taking into account, obviously is on the table. Both of those would be bearish for the greenback. That means interest rate expectations will get pushed out. On a trade like that, where it's a conviction shift in what the consensus is, you need to be a little bit more aggressive to put your foot on the pedal. That's just a possibility, Avery, that would make me be a little bit more confident to jump into the trade right after the release. All I can say to you guys is this: on a release like this, if you're not comfortable with the strategy, if you haven't been aggressively trading these announcements before, it's an easy way to get chopped up. So just use some caution. Again, if you're newer, I would sit around, just watch price action, watch how the market reacts. For us, Avery, it's the same exact play, only you're doing it faster. So let's say the release comes out, euro breaks sub 109.50 or 109 here, 108.90. You see a drop into the 108 handle, it comes up and holds, and then you get another short trigger, or during the presser it starts to break down again. A stop against that high, looking for a move into the what was that, 236 at 107.50 could be a play. With the same respect, if you look at another pair, what was the next pair we wanted to cover? The British pound, right? Here's what sterling looks like now. Whoops, I hate when I do that. And you can see that we're still within the confines of this formation we've been looking at. Came off a big resistance level. At the meeting, you're at support, right? So let's say this jackknifes out on the back of the meeting, comes into meeting line resistance, and it whipsaws down. Great. You're looking for a break below that, and we'll look to sell. That might happen later tonight. It might happen tomorrow. It might not happen until next week. So it really depends on how severe the market reaction is. I really don't want to encourage too many people to just jump in on the back of the release right off the bat. Typically, on a move like this, the initial reaction is not what sticks. You get a lot of these massive runs, but when you're at key levels, the benefit is you have a conviction stop. So if this thing was to rally right into here and fail and start to break down, stop against this high, you're good to go. So it has to be, we can go over a million different scenarios, and Mark is saying it here. Everybody and his brother is looking at this scenario. What are the chances this happens? That's why I'm starting to get really shook about it, Mark. A lot of people are starting to expect that the Fed's going to come out, raise rates, and sound dovish. Seems like the logical thing to do, but we'll have to see. We'll have to see. With the consensus building as it was, you'd have to see what the initial reaction is. Avery, does that make sense? I hope I didn't kind of like sidetrack there. Again, there's not like a guide I can give you. Just wait for X, Y, Z to occur and then jump in. We'll have to see what the release looks like. Hey guys, can I get confirmation that the sound is working? Someone said that the mic went out. Okay. Yeah, Chris, I think that's just you. Thanks, guys. Thanks, Farouk. Let me just send Chris a message here. Okay. So then again, Avery, I hope that makes sense. Yes, it does. How about the pre-FOMC no trade zone? Heading into the FOMC, I have often taken positions. Yeah, I try not to think too much about it, guys. I just want to know if I'm in a trade and I'm heading into FOMC, I won't necessarily bail, might reduce position size, actually tend to push my stops out a little more, just some volatility. I don't get I don't get stopped out just on a swing type of trade, but try not to overthink it, guys. Try not to overthink it. Remember, for us here on SB and for our styles of trading, for me and Jamie, the technicals are fundamental. Okay, these announcements are just triggers, times of which it could be a catalyst for the next move, whether it's a correction or whether it's continuation in the broader trend. So I hope that doesn't throw you off. Says, yeah, and thanks for explaining it so well. Much appreciated. Cheers, Avery. All right, guys, feel free to throw out any questions. Again, I'm all yours. Here's sterling dollar. Here's what we looked like yesterday. We talked about this region right here offering some support right below 150.25. It's been a little messy play here for the pound. I'm looking for support. The broader bullish invalidation level is still 149.49 to be technical about it. That's the low day close that we made earlier in the month on the 2nd. And that would necessitate clearing this upper median line parallel. So a daily close below that would shift the focus lower. Your next key support is into like 148.50, 148.50, 58, this region here. So for the pound, if we get a weaker dollar story, this might be one of the ones you'll want to play. The pivot, again, keep that 51.18, 51.13 level in view. Still a pretty big region. While you're talking, can you put up the 30-minute chart again, please? Sure can, yeah. Here it is. Again, a quick reminder, if you're newer to the room, there's a camera button in the top right-hand corner of your screen. Feel free to click on that if you want to take a snapshot of any of the charts we're going over. All right, hope that helps, Kyle. And remember, guys, the scale charts are all provided for you. So on the Euro chart, just click on the link. It'll take you to the previous update, which had the scale charts right on it. No change. No change. All right, any questions on Euro dollar or pound? Probably one of the more popular two that you'll get moving aside from dollar yen. I just want to jump into that. Dollar yen hasn't been a setup I've traded at all this week, guys, just as a disclaimer here. But definitely, something that tends to react very strongly to US data. Yesterday we highlighted, excuse me, this 121.90 level, 121.83. You had slope resistance coming right into that of the same operative slope off the highs. And momentum showing some divergence. Price action making a higher high, the oscillator making a lower high. Here's what dollar yen looks like now. So you're getting that juice. I'm losing my voice before FOMC even comes. Um, you're getting that ongoing divergence continuing here. So again, price action made a higher high. Again, the oscillator continues to hold shy of that previous high. And the risk here on a dollar pullback is you're at resistance. Okay. There's a lot to look at on the daily chart as well. 618 extension off the high came in at 22.11. That was right at the breakdown zone earlier this month. 618 retracement. This is just an older retracement of the range since the June high. And just below, you have the confluence of the 100 and 200-day moving averages. 121.57, both of them on the dot. So this thing is primed to the pump. Watch 121.60 on support. Watch 122.11, 122.12 as resistance. And it's likely to give you a decent break. At a pretty nice juncture here. Also, just near term, this is too early to tell, but a proposed pitchfork off the low here seems to be giving us some guidance. And that comes in right in that same zone above that 22.11, 22.13 zone. Right here is the 618 of the decline. So your breakout zone is where you'd look for a much stronger dollar-yen rally if this thing breaks higher from here. Base case scenario, again, is you stretch into a new high and you look for short triggers up near the upper median line parallel, near this region here at the 618. Either way, the key support structure that you need to get into, this is just from a scalp basis, is still through that confluence region, 122.58, 122.57. Does that make sense on the dollar yen, guys? Sort of my game plan moving forward. If we're gonna get a breakdown, you wouldn't want it going too far past that 618 at 122.25. That's sort of where you'd want that to hold. Note that that was also the previous monthly opening range low, which we broke here on the 9th. Comes in right around where trendline resistance is. All right. So that is dollar yen. Okay. Also highlighted in yesterday's piece was Aussie Dollar. This is the pair that I've been most active in this week at least. Here's what Aussie looks like right now on the daily chart. And I'll show you the intraday chart in just a moment. I wanted to highlight, conviction in your levels, guys, is such a huge part of trading. And there were some opportunities today or this week that I did miss on the Aussie, although I've been in and out of it multiple times just because I got shook out. The level of support has been rock solid, 71.56 into 71.77, 20 pip range of support, but you've seen us rebound off that 3 times out of the last 5 sessions. You also have the 100-day moving average hovering just above. Okay, momentum, right at momentum support. So this thing is kind of like dollar yen. It should be a very nice break. If we get a breakdown to the shorts, you're looking for 70.94. That's a basic 786. Retracement also is former trendline resistance, may offer some support. The opening range for the week, which was set in the last 2 days, put a high at 72.81. Well, that's interesting because that's the high here for November. And it's also just pips off the high for September. Big pivot in price, trendline resistance right there at this point as well. Key resistance 72.80, key support 71.55. Let's look for a break. Here's what the Aussie looks like on the 30-minute. Okay, and here's what we looked like last night. So no changes to any of the levels here as well. You saw us break that upper median line parallel, test it as support, and here we are rebounding off. So major key resistance, or I wouldn't say major key resistance, but a near-term resistance range would still be 72.27 to 72.35. This is the region for a breakout play in Aussie if we get it on the back of the FOMC announcement right here. And that currently comes in just ahead of the 618 that we tagged earlier yesterday. If you guys remember, um, yesterday during the webinar, we were looking at the session opening range. This thing blasted so much lower than I had expected. I thought we were going to find some support at least at the 618, but this thing just kept on going. So I actually didn't get a chance to get any additional shorts on that drop, unfortunately, as clean as it was. Did jump into a long position here kind of late. I was stretching the ATR to its max here, and we just triggered out an overnight trade, or late, actually before we even closed the session, before we even called it a day. So at this point, you're looking for either a rally up here for short exposure. If it breaks, I wouldn't go chasing. Wait for the pullback. You're likely to see a pullback of some sorts, and then in Asia, we can jump into another position. On the Aussie specifically, if it breaks to the upside, I want to definitely see the Asia open before I really start to get aggressive on the long scalps. That being said, you know where key support is, right? There's a lot there. So another really clean setup as far as the levels. We just want to get closer to either a support or resistance range on this release, because right now you're basically at the weekly open, slightly higher. All right, but extremely clean as far as the structure that we're trading within. And there's 71.56, a huge pivot in price. We've made resistance, resistance, break, instant support, support. On the way down, support, support. That's really the level to be. Mark says, in your experience, is gold any indication before news events like this? Gold actually does tend to do pretty wicked stuff, Mark, ahead of these releases. I think the gold market is at a dangerous spot right now. I was messing around with this earlier today. Look, as crazy as it sounds, I'm really not that bearish on gold down here. At least I think you can get a decent size rally taking you higher from where you are. This looks like screaming near-term correction. I could be completely wrong, guys. I don't know. I haven't been intraday trading gold, but okay, we overshot 100% extension here on the decline. Okay, two things I wanted to point out here on gold. First of all, Mark, the monthly opening range is pretty well set and defined at this point, right above support. So if you look back here, this is a basic trendline support extending off the November lows. And this is a 618 extension off the high, more importantly, that 1053 level. On the weekly chart for gold, if you can just bear with me a minute here, on the weekly chart for gold, 1053, you can see how huge of a level that is. Right, it's right off the 2012 highs. Okay, and look what we did when we tested this back on the 28th of last month. That week we put in an outside reversal candle off of support. Doesn't get much better than that. So I do expect that you'll see at least a tag up into 1098, which is the low we closed previous to the one that we made here this month. And that also lines up pretty darn nicely with the September lows and a basic 38.2 of the decline. So we were looking at this rally early in the month, looking for a stretch higher. We didn't get it. You pushed back. You basically made a sweet opening range for the month, and you're looking for a break. Interestingly enough, the slope we were looking at earlier in the month, this one, if you just tack on a slope using that same low, but the new highs and lows, it's the same exact slope. Okay, you don't see that too often. So as long as we're kind of staying within the confines of this formation near term, I wouldn't be surprised to see a break higher. Again, near term resistance, look first for the the monthly opening range high, that's 1088. And then this is a little bit more of a key resistance level, 1098 into 1100 basically. Breakdown zone, very, very simple. If we break the lows that we made yesterday, again, look for initial targets at 1053, but that's sort of it. If that gives way, sayonara. We'll have to go to the weekly chart, see the next downside target doesn't come into like 979, 975. So interesting positioning ahead of FOMC on gold. Definitely agree with you on that. Mark, I hope that helps. He says, yes, thank you, more than welcome. Mark Haverman says, I got that one. Pietro says, hi, Michael. How do you trade this major events? Do you trade at news releases before or after? Guys, it's hard for, okay, I don't want to like sidetrack here too much, Pietro, but listen. A great trader once told me, you don't want to trade the event. You want to trade into the event. Okay, so a lot of times your ideal scenario, Pietro, is that you're in a position, the market does what it's going to do. You have a little bit more comfy of a pillow, allowing for volatility, and use that surge in price to get out as opposed to getting in. Okay, when you're coming into an interest rate decision, specifically one as significant as the one we're getting today, where we haven't seen them hike rates since 2006. I personally, I want to be on the sidelines. I'm flat. If the U.S. opening range gives me something, sure, I'll trade it. But guess what? It'll be at a quarter leverage of what I typically use. If the trade is in the money and I like the positioning and the trade looks fine into the release, great. I'll adjust my stops, my limit, and I'll let it play out. I'm already playing with a third of my typical leverage, right? And there's no reason to close a profitable trade just on account of the interest rate decision. If anything, I'd be reducing position size. That's something always prudent to do, and let that play out. Another way you can play it, Pietro, and the way that if you're going to do it, if you're not in a position now, it's probably the way you're going to look to play it, is wait for the release to settle and let the dust settle. You're going to see some knee-jerk reactions. You're going to see some major presses on some levels that we've been looking at. If you don't get the entry, don't go chasing. Not in this market, okay? Let the dust settle. Once Asia comes online and the Asia markets start to open, all these guys are going to just start reacting, okay, to what we did here in the U.S. A lot of times it takes that around the globe. Sometimes you can still get the plays. Just wait for the next session open. So Craig Wingate says, I would love to watch you actually trade high impact releases on a volatile day. You don't need to talk or interrupt your trading. I just want to watch real time. Have you guys considered such a thing? Craig, we have. As comfortable as a trader as you are, trading is a very personal thing, guys. I'm not gonna lie to you. If you've been doing this for a while, you know our stance on this. It's not easy having a camera in your face while you're trading and you're trying to focus on the markets. That said, Mark, it's definitely something I'm open to. I got no problem with that. We could probably just open up a session one day and let it run, and we can trade it as is. The only thing is this: I don't want people in general, traders in general, there should be no pressure to put a position on in a market like this. If the entries are there and the triggers are there and the levels are working, there's no reason not to take a trade. But there's what they call FOMO, fear of missing out. And traders will be like, oh, I missed the move. I need to catch something on this. This is such a big release. I've been waiting for this for a year. Finally move my interest rates. And they'll look for a pair that looks like it's lagging and they'll jump in. You got to make sure we're staying prudent, guys. This isn't a game. Losing sucks. And we have to make sure that we're being prudent with our risk management and that we're staying disciplined to our strategy. It's very easy to throw all caution out the window and start running into trades on a position like this, guys. Or on a release like this. So just keep your wits about you. Let's just say that. Euro yen, please, Minho says, sure. Did we cover dollar yen? We did. Let me just do dollar Swiss real quick, and then we'll jump into the crosses, Minho, okay? So dollar Swiss, again, a pair I typically hate, is coming to a very interesting area, and it's actually pretty clear, so we want to watch it. Here's what the daily chart looks like. This is a pitchfork. We talked about it yesterday. I've adjusted some of the levels, so if you guys took a snapshot yesterday, you might want to kind of retake this. This is a basic median line parallel. This is the actual basic trend line support. It comes a little bit lower. But the premise or the main thing that we're looking at is this. 9,800 is the 618 of the October advance. It's the 200-day moving average, or excuse me, the 100-day moving average. And it's that slope resistance, or support rather, we just talked about. So that's clear. 99.12, well, that's just basically right at the opening range high for the week. a decent pivot in price, and the highs from August. So your key range heading into FOMC is 112 pip range from 99.12 into the 98 handle. Here's what it looks like on the intraday charts. We looked at this yesterday here in the webinar. I added this on this morning. It could be a proposed slope off the low here, could be in play. You did see that last dip there and overnight give us a nice hold before it rocketed back up. But it looks like we're kind of holding this slope. So nothing I'm operating on the premise of just yet, but certainly a clear opening range has been set above support. So on a breakout type of play, remember what I always say, a break to the upside of an ascending slope typically will be the sharpest move. A break to the downside of a descending slope typically will be the sharpest move. So we kind of got a game plan here on in a story where we get super dollar strength. If they come out, the dot plot shows all those interest rate expectations for hikes being brought down more or brought up more in this chart, I suppose I should be saying. You'll see that dollar break through the highs and a break of the upper median line parallel, i.e. the weekly opening range, should give this thing some legs. Looking at 99.25 and basically parity. Or excuse me, 99.92 and parity, right around these regions. Any questions on dollar Swiss? Okay. Last but not least, a quick look at dollar CAD. Did someone just ask about that? Avery. Dollar CAD SSI is at an extreme. Are you looking out for a short? You know, I think I am. I'm not going to lie to you. You're at a resistance, and I think you have a clear region of which, if it breaks through, which it looks like he wants to try again now, I don't want to touch it. My problem with dollar CAD, guys, is that we haven't had price action in this range since, what, early 2000s? Yeah, 2004, right? So my problem is that I don't have any real scalp targets that I can work with on the north side of this trade, right? That's, you know, it's like a 240 pip move up there. With the 1618 extension off the lows from October, this broader extension has offered some really nice moves, but I'm not going to try to short a trade while it's in overbought territory, right? It's just not my gig. Just not my gig. Now, objectively speaking, here's what the intraday chart looks like. Okay, there's that 1618 extension. More importantly, some slopes of the advance. If you just take basic slope support, right, and the median line formation, all the same slope. If you look at it, confluence right here. We look at this to start the week. We've spiked above it twice, but very clear weekly opening range is set. 37.80. The opening range low, I would stretch right into this region. I'm not going to play a 15 pip, 10 pip move here. But 36.65 to 36.56, that would be a breakdown, in my opinion, of the weekly opening range. You'd look to play down to slope support in that scenario. All right. I like the opportunity, let's say this, Avery, to get on the short side if it's going to be a weaker dollar story. If it breaks up to the upside, I just don't have levels that I'd be comfortable with really trying to intraday scalp. I mean, the next level here would be just a median line. Depending on time, you're basically looking at, if you look at 2 o'clock, you're looking like 38.75, 38.77. Does that make sense? Avery says, would love to see dollar CAD top out 138.12, as Jamie said. Yeah, I mean, the longer term plays, again, looking at the daily charts, probably going to give you the better levels. Probably like an outside weekly close or something like that he's looking at. Actually, let's put this into a weekly chart real quick. Bear with me, guys. Yeah, there's some interesting stuff here. I'm still working with that pivot at 618. So again, different styles of trading as far as trying to call these major rallies into new highs. I really don't have a game plan here. I'm not gonna lie to you, Avery. For me, it's kind of a moot point. If it turns over and you get a pullback in momentum sub 70, price action makes a weekly opening range break a little bit clearer back below that trend line. Yeah, I'd look to sell rallies. I know it's just not my style to try to sell into a major resistance level, kind of hope for the pullback. Again, different strategies. Jamie's strategy, that's where it shines, guys. And that's why you guys have the benefit of both, the cream of the crop from both sides. Yes, got the short-term picture from Dollar CAD. Many thanks. You're more than welcome. Definitely a pair I'll be looking at. But every time, the markets have tried to give this thing a pullback or call a high, it's been a messy scenario. So for me, I'd need to see at least a break of the weekly opening range. I mean, this thing has never broken the weekly opening range to the downside yet, guys. Sometimes the weekly opening range has been preserved, and you just make it and you hold into the next following week, like we did right here into the open of December. But you haven't seen any opening range breaks to the downside. Here's one that was a false break, quickly recovered, and closed higher on the week. Long story short, with where the momentum signature is, it is vulnerable, right? But I'd want to see a little bit more of a break sub 136.56, 136.65. Okay, that's all the dollar crosses. Rapid fire. Feel free to throw any questions or trade setups you guys want to look at. I want to take that question from Minho. I wanted to look at Euro Yen. Sure can. Here's what Euro Yen looks like now. First on the daily chart. I think we had a Euro Yen position not yesterday. So here's Euro Yen back on the 14th to start the week. On the near-term chart, we were holding within the confines of this nice descending channel formation. We did actually break above this. We talked about it yesterday, and now we're just making a clean opening range. So my notes here for Euro Yen, literally I have something that said nothing. I think what I meant is nothing for the week so far. So, we're still in that slope. Excuse me. We came right into that resistance yesterday, and it actually held. So slope support offered some, or the median line offered some support rather, and we're still trading within this. It's trying to break to the upside, but at this point I don't care because I have a clear opening range. Opening range high at 133.50. Really nice pivot in price, 50% retrace of the decline. And momentum is completely range bound. 60 support, 40 support, 60 resistance, 40 support, 60 resistance. No play here yet. I think you got a lot better bang for your buck. This is why I didn't update this since the 14th. It's just if you look at the ATR on it, it's 26 pips, which is decent, but not quite as clean, I think, as the other levels, as the other setups we've been looking at. So look for an opening range break. If 33.50 maxes out and breaks through, remember where we're looking for is resistance, the same level we ran into earlier in the month. 200-day moving average comes in at 134.14. Look what happens. It's right in line with the upper median line parallel right now today. So clean levels on a rally or a yen sell-off would likely be the culprit here to make this rally. If that does break the weekly opening range high, the resistance range we're testing right now in the near term, you'd look for that rally towards 134.14.
Industrial production in U.S. fell 0.6% in November.
And we're just getting industrial production numbers, guys. 77%. We were looking for a print of 77.4. Excuse me, that's capacity utilization. Industrial production comes in at negative 0.6. That's worse than expected. We were expecting a contraction of 0.2%. Quick look at the dollar, relatively speaking, see if we're getting any play on this. I don't feel like we would ahead of the Fed. Both numbers weaker than expected, so see if it's got enough juice to push this lower. Minot says, thanks for the update. You're more than welcome. Minot, let me know if you have any other questions on Euro Yen. So again, just to highlight the importance of that 3270 zone. Let's mark it right here. Okay, that 38.2, longer term median line, right there. Mark, thanks for pointing that out. It says U.S. industrial production is the biggest decline since March of 2012. That's interesting. Again, I don't think it's going to be enough to change sentiment. I don't think the Fed's going to actually move on a print like that. But again, it all adds to the dynamic. At the end of the day, guys, it's a lose-lose situation for the Fed. They were delayed in making the first rate hike. And at this point, they've painted themselves into a corner. It doesn't matter that there is global risk to the economic, or global growth has risks to it posed right now, both from the route, again, like I said earlier, that we've seen in commodities and just some of the volatility that we've seen. But they can't hold rates longer at this rate any lower, especially if they're using their dual mandate of fostering maximum employment and price stability. Maximum employment, the natural rate that they quote unquote put as the natural rate unemployment, is basically where we are right now. Inflation, while it's a little bit laggard, they continue to postulate that it's just transitory, that all of these, that inflation is going to rise to the 2% target in the medium term. So with that kind of, if those are really the two mandates they're looking at, it's very difficult to see them not, being able to justify a continued hold here at zero rates. Mark, you're absolutely right. And more than 100,000 of announced layoffs have been reflected in NFPs yet. Have not been reflected in NFPs yet. Heck, probably 250,000 of layoffs. Yeah, Mark, I mean, something like that. Okay, we can talk about that as well. But in any event, the unemployment number is extremely overstating the health of the market. I think we all know that. In fact, even Yellen herself said the headline unemployment number is really probably not an accurate portrayal of what the real market conditions are. But the problem is that the problem the U.S. is facing is that a lot of these problems that you're seeing are at this point structural, right? Companies have learned to do more with less since the recession, and some of the jobs that got laid off might never actually come back. So you're seeing the participation rate, while it is upticking off of a low we haven't seen since the 1970s, really hasn't been a strong print for broader participation in the labor force. So there's a lot of reasons not to actually stress that 5% unemployment number. And even so, Mark, if it doesn't account for those layoffs, I don't think really anyone's putting too much emphasis on that. More so, I think that the Fed has also been looking very closely at wage growth, which is something that they've continued to say, again, has been a little bit more of a laggard right now. Be it as it may, we're not here to try to ascertain policy or make policy. We're here to trade it, right? So the risk remains is if they don't hike, if they do hike, we'll be looking very closely at the dot plot to see what that shift looks like. Have they actually pushed out interest rate expectations, or have they pulled them in? Have they reduced their growth forecasts? If you see that the inflation forecast specifically with the deflationary concerns we have globally, if the inflation forecast is being lowered, that would suggest that the pace of tightening is going to be extremely slow. Okay, and if that's the case, again, adjustments to the dollar will likely push that lower. It all comes full circle, right, to what the trade is. And he says, nah, technicals rule. Amen, Mark. Amen, my friend. All right. Thanks, Mike. Sterling crosses Aussie and Kiwi, please. Craig, coming right up, my man. Yes, Aussie Kiwi I have on my list here. There's a trendline support I'm looking at, and there's also a mirror support, which would be a really nice if it breaks the lows. So here, I know it's from yesterday. I have show parallel support as well for target. Oh, I know what I was saying. Okay, cool. So if you look at the Aussie dollar from the daily chart, we talked about this slope ad nauseum. So I'm not going to bore you guys with that again. Near term, you have a basic trendline support off the second low that you made here in April, connected to the low you made in October. It's basically where we found support yesterday. Also, within the confines of the current operative slope, a sliding parallel off of the late August high. Resistance, turned ahead of, resistance, break, support. So you kind of bottomed at a really nice region of support. This is going to be your near-term bullish invalidation level. So if we break down, you can continue to favor those downside targets towards 105.57, 104.40. This is a measured run, okay, of that range from the July-September low high. And also, if we do break this support, that same slope we were talking about since the 2013 January low, let's just mirror that. Comes up real nice. Right around that 618, 105.57, just below 105.40. So real clear cut as far as what I'd be looking for if we break support. Resistance, 107.20, 107.30 is going to be critical. Again, that same slope. More importantly, that 618 pivot in price. You got 50% of the yearly range and a 618 just off the ascent from November. Right there. So Craig, I love it when the daily chart is this clear because that gives me a lot more conviction on the scalp chart. Bottom line, near term, you're at support, resistance 107.20, 107.30, looking lower below that. Break of support, you're looking for 105.57, and that slope support, let's say 105.40. Here's what the intraday chart looks like for Aussie Key. All the same levels. 786, we didn't have that on the daily chart. 106.23 still looks like what it's holding now. Again, that longer term slope I don't have on this daily chart, but as far as the highs are concerned, 107.20, 107.30, again. Near term, that's going to be the slope confluence you'll be looking for. So maybe another ditch at the bottom, maybe another press into the bottom before we rally back in 720, or if Kiwi just drops off and it kind of just runs right into this region, might offer some nice short exposure. But from right here, again, a trade I haven't necessarily been involved in this week yet. Yet being the key word here. Any questions, Craig, on Aussie Key? Quick review of Euro Aussie. That was from earlier in the week. Here's what the Euro Aussie looks like on the daily chart. And here's what Euro Aussie looked like earlier in the week. We highlighted that major resistance at 52.98, basically a 53 handle. Well, since this report was published here on the 14th, we've made a couple more attempts and they've all failed in that same region. Just so happens, though, that at this point, the weekly opening range is setting up right above support. So again, gives you clear conviction. Opening range high is right at resistance. Opening range low is right off slope support, and you look for that break. Here's what the intraday chart looked like earlier in the week. We already nixed this downside slope, and you can see that all it's done is made a very clean opening range. That's it. So you're looking for either a break, conviction break sub 51.47, this region here, confluence of the 618 extension, and a basic 50% retracement. and that would give us downside targets into 51 and 50.36, a much wider range ATR. Very important we keep that in mind here. So you're looking at about 50 pips per scalp, give or take, and as such, your stops can't be any farther out than that at maximum. I like a downside break, but with where Aussie's trading right now, I'm a little concerned. Here's what Aussie Dollar looks like. Again, I think we talked about this in this session, right? So if we see the rally in Aussie Dollar to push higher, that could be the culprit. That would give us a little more of a pullback in Euro Oz. Let us play that that breakdown near term. Again, something to pay attention to. Momentum signature since the high that we made. 40 support, 60 resistance. Can't even get to 40, can't even get to 60. That's a flat range bound market. Look for this to change. Pietro, you want to look at Euro CAD. He says nice ATR. So Euro CAD's at a very interesting area as well. You're basically testing the close highs, or the close day, the high day close rather, excuse me, from September. You probed through it a couple of times, but I'm not really convinced. So I think you could get a pullback on a trade like this. Unfortunately, geez, the bullish invalidation is still way down here. So I'm really reluctant to play the long side from here. You could get a pullback. Let me show you the scalp for Euro CAD. This is just something I was messing around with last night. Looking at basic trendline resistance off the high. And this was the weekly opening range low. Would have been a nice break if it would have held, but we rebounded pretty quick. And it's very likened to what we saw in some of those other trades where we kind of broke that weekly opening range and jumped right back above. No. Interesting. Take a step back here. All right. Yeah, I don't really have a very conviction on this one either way, to be honest with you. What question was for Pietro? It does have a nice ATR. We just went over Euro Oz. It has even a bigger ATR at 50 pips. So if you're looking for something with a little bit more juice on it, I think you're better off there. Here, you're kind of like unchanged for the week. The opening range is sub-resistance, which again was that 618 retracement. That makes sense. But if anything, I think you'd probably see another break of this to the upside, and then you look to sell a rally against that high. And the other thing is with this one, you have to watch the CAD, man. You got to watch if dollar CAD breaks that high. Oof, it's going to be quite a run. Pietro, does that make sense on Euro CAD? Again, I'm sorry I didn't have. I wish I had a more conviction trade for you on that one, but not on my menu right now. He says, yes, perfect. I've been watching U.S. oil at the same time. Yeah, so U.S. oil, I wanted to just jump into commodities before we wrap things up here. Here's what U.S. oil looks like. So we talked about this yesterday, right? 34.85, lower median line parallel, nice confluence support. You saw it rally right into resistance. That held. Following day, we saw another break above or back above that low that we made. What year is that? 2009. Made it back above the 2009 low. The 2015 previous low day close from October, or this was August rather, was 38. And that just happened to coincide with slope resistance. We talked about this yesterday. And then a sliding parallel is right there as well. So the level to beat here is going to be 38 to give you any type of upside justification. If it does mount 38, I do look for a much more substantiated rally towards 40, 39.80, this region, and even stronger rally would take you back into the upper median line parallel, depending on where you are. If it turns here and breaks above, this would be pretty big, in my opinion. A break back below 36 puts you right back in targets again. The only thing about the short side is you're coming into some congestion here because that median line, the broader one, okay, has been holding price action for the entirety of the year. So it's going to be pretty hard to, justify any type of short exposure if we break back to the downside. More likely, in my humble opinion, is if you get break to the upside, look to buy pullbacks targeting 40 and then the upper median line parallel. And based where we are in time, that 100-day moving average is likely to track right into there as well. All right, it's a downtrend at support, guys. So play the longs cautiously if we see this break. Otherwise, you're looking lower. It's just that we came off a big support region here, so I want to be mindful of that. Pietro, does that help on crude? A lot of people are going to be watching this, especially today. And this, again, remember, even the projections have implications for crude. What does GDP look like? What does the Fed expect growth to look like? What does the Fed expect consumers or inflation and interest rates to look like? That's all going to impact what we're seeing here in some of these really weak commodities. And again, obviously, it's a story around the board. Here is silver. That came into a major, wouldn't call it major, but on these longer term retracements that are multi-year in nature, they will offer some nice plays. And 88.6 catches the low at 13.62, excuse me. And you're seeing that move higher from here. It's almost unchanged on the month. That's exactly where we just maxed out. Actually, drop a little line there. So here's a monthly open. Just encountered it as resistance. You had some divergence into the low. Could get a little bit more of an up play. But it seems to be the same story across the board. Here's palladium. Right? A lot of these are testing some serious lows. So we want to be cautious before trying to call low on that. All right. Any other questions before we wrap things up, guys? I want to wish everyone best of luck trading today. Stay prudent. Again, it's a pretty big release. It's been years, literally, since we've seen an interest rate hike. So, the behavior of how the market's going to react should be interesting. Most of us, or most of the market, I should say, is factoring in that we will get this hike. The devil's going to be in the details as far as the projections and where the Fed sees policy moving forward. It's going to be very unlikely they're going to want to pre-commit. They're more likely to say it's going to be data dependent, yada, yada. The market's interpretation of that is really what we'll be trading. And if the interest rate expectations get pushed out, if we look at that Fed futures rate and you start to see the interest rate expectations getting pushed out in the calendar year, then you're likely to see the dollar come off. If it's a rosy, much more upbeat, thing where we're coming closer to target, the international or global growth story is not something that really is a concern right now, and they're much more hawkish, that would be, a recipe for a major dollar rally if we make it through that key resistance near term. Okay. All right, we'll wrap things up here. Quick reminder, Jamie's midweek strategy webinar gets moved tomorrow till 1 p.m. Eastern. Again, ahead of, or on the back of rather, this FOMC interest rate decision. So we'll be able to review the swing updates, a little bit more of a longer term outlook on what the implications of today are. We'll also be here tomorrow morning, as always, at 8:30 Eastern for the next intraday webinar. Best of luck trading, guys, today, and I'll see you tomorrow. Cheers.